Bhattarcharya joining us on the show, who is the President and CIO Equities at Edelweiss AMC. Very good afternoon to you, Mr. Bhattarcharya. Thank you so much for joining us on ET Now. And yes, since we last spoke, I believe the market fall has only accelerated. What do you make of this sort of a market construct?
I think basically a whole lot of volatility in global markets with regards to the change of regimes. And I think on a bottom-up basis in India, in the September quarter result season, net earnings downgrades have been more than upgrades. So in a way, we have seen a bit of a pause in the earnings upgrade cycle that we have been observing for the last 2 years. So these two put together would be my thinking behind the correction that we have seen. But having said all of this, I think it was a healthy correction. It was a correction that was very much needed in a market which has gone one way over the last 2 years.
It was a healthy correction, but the biggest question here right now that everyone has is that how long will this correction last? What is what are your internal estimates? What are your understanding about this?
My thinking is ultimately markets are a slave of earnings, and as earnings come, so will the markets be. So will the markets actually benefit the same. So, in my opinion, the September quarter result season probably saw an earnings downgrade of about 4 to 5% amongst the companies of any interest. The next chance of earnings upgrade would be in the December quarter numbers, which will come through in January overall. So I think till that period of time, I would probably anticipate a bit of a volatile market. And as we get more feelers about earnings for the third quarter fiscal 25, that's when I would expect to market to come back. By the way, my expectation is a lot of whether it's wedding dates, whether it is monsoon-related benefit in the rural India, and also government decision-making will actually come through in the second half. So I do expect earnings to be robust in the second half of the year, but I think the market will wait to see some sort of a telltale signs of the same before reacting. And that's where I think markets would actually come back.
Right. And the fact that you're expecting our earnings to bounce back in the second half of this financial and also for the next financial year, which are those sectors where you're expecting the highest jump to come in, and those sectors where investors should keep an eye out for?
So incrementally speaking, over the last 3 to 6 months, we have added meaningfully to IT services as a sector in our portfolios. We have also added to financials, particularly the NBFCs and the banks, more on the private side than on the public side. We've taken profits out of the public sector financial enterprises and moved on to the private sector enterprises, but we have added to financials over the last few months. We have also added to real estate. We think that globally, as we move to slightly lower interest rate regime, and along with that in India might be a bit of a laggard, I think real estate would also start to see a bit of a benefit come through over a period of time. And finally, we've added to rural economy exposed stocks in the consumption basket. So those would be the 4 areas where we've added. And obviously, by that logic, we are confident that earnings would be relatively resilient in these areas over the next 12 to 18 months.
You are also saying that yes, the earnings to that market will wait till it sees signs and earnings recovery, and that can happen only in January 2025 when the Q3 numbers will come out. But don't you think that there is some valuation comfort right now that we can see, at least when it comes to the large cap, mid cap, and small cap, is still somewhat at a premium compared to their 5-year averages, but large cap valuations have come down at least by around 1% compared to their 5-year averages currently?
So we are actually at the moment hunting for ideas. It's not that we are sort of waiting for Q3 results to actually kind of increase our holdings. In pockets of value where stocks have corrected more than what fundamentals have warranted, and when we expect the second half and strong FY26, we are in the market hunting for value, and some stocks in the large caps do offer that opportunity even as we speak. But what we are mindful of, that overall, from the next 2 to 3 months perspective, given how the macro is lined up with Maharashtra elections and a few other macro events, we want to be gradual in our picking up stocks rather than in one go. and that's what I would advise investors to do as well. Expect a bit of volatility in the near term, but large cap valuations are very much in line with 10-year average. So there is absolutely no froth, so to speak, at current levels in the large caps. In mid caps, valuations are about 20 to 40% higher than 10-year average. But in pockets, growth is also likely to be stronger. So we want to be selective within mid and small caps, and large caps we are fine with investing. So that's how we would probably think about investing in the current markets.
Right. And now if you talk sector specific, auto is one space where we have seen some big correction come in stock specific names like Bajaj Auto, or for that matter Maruti has also corrected from its peak. But obviously there has been auto slowdown that was one of the major reason why we have seen this correction. But going forward, what is your view when it comes to this sector? Because discounts continue to remain high when it comes to the four-wheeler space. Two-wheeler space is still seeing some demand revival, demand growth coming in. So how are you looking at the auto sector currently?
In my opinion, auto sector is at a crossroads of 2 or 3 trends which are happening. One, and not to forget, is that last year growth base is reasonably high. So on the back of that, particularly in passenger vehicles, to record or to clock another double-digit growth would be difficult. That was anticipated by us and reflected in our portfolios as well. Hence, relatively speaking, we are more oriented toward two-wheelers. But within that, in terms of the lay of the land with regards to demand, I think what you've seen in the first half are lack of auspicious days as well impacting the growth. And I think relatively speaking versus first half, you will see second half turning out to be better even with regards to auto. But if you look at the year in totality, this year would be a slow year for autos overall. And likewise, in our portfolios, we are actually neutral to underweight autos. And within that, we are more oriented towards two-wheelers, which in our opinion, relatively will score better with regards to volume momentum, respond better to festive demand, and also there are a few other triggers that are company specific and lined up in this context.
All right, so that's the view coming in on the auto space where you have a neutral to underweight stance, and if you are tilted, then it's the two-wheeler space that would look much better. Thank you so much, Mr. Bhattacharya, for joining us on ET Now to share your views on the markets. Pleasure. And where you see value going ahead. But moving on, the government...
If you like this video, then like, share and subscribe to ET Now.